Hi, I'm Batu from freefincal. In this video, I want to talk to you about what is wrong with ICICI Value Discovery and Quantum Long-Term Equity. Both are value-oriented funds, and their performance over the last 3 years, over the last 5 years, maybe even a bit longer, has been quite bad. And that's, of course, compared to both their own respective benchmarks. Sensex for Quantum and BSE 500 for the Value Discovery Fund, and of course also with respect to peers. Now, there's no that's a fact that the fact that that these funds are not being performing is cannot be disputed, and that's it's data based. But the point is, should we as investors be angry with these fund managers? Have these fund managers done something wrong? And this is a question that I mean, there are always two sides to a problem, and from an investor's point of view, returns matter. And when the AMC says there's a benchmark and I'm going to try and beat it via some strategy, then they better beat it, and they have both failed. And if you want to consider exiting the fund, then definitely that's a reasonable thing to do. And I think inflows into both these funds have become are going to be difficult. Significant inflows are not going to come. At least for ICICI, it's a big AMC. They don't, even if they don't get inflows here, they will just launch another NFO, put Shankaran Narayan's name into it, and get some money. Or they have other funds which are performing reasonably better than this. But in the case of Quantum, it's basically a one fund AMC, and I think Quantum has not even touched 1,000 crores with this fund after being in existence for more than 10 years. So they have to perform, and Quantum has this and the problem is, and if your strategy is not performing and people are not going to put more money into it, then will you still stick to your strategy, or will you try to deviate? And that's a question that we have to consider, and we're going to talk about another angle to the whole thing. And I'm not going to show you returns here because that's a given, but we're going to talk about another angle. And my question is, and this is a poll I just started in Asana for Wealth: if your fund is underperforming, is it okay with you if your fund manager deviates from the investment strategy? So, is it okay if a fund manager deviates from a given mandate or a given investment strategy to address underperformance? Now, if I ask the question like this, many people will say, no, strategy is important, and that's how it has been in that poll. But when it comes to practical holding a fund, how many people are willing to say value funds will always underperform for extended periods of time? Portfolio returns is more important. Portfolio risk and portfolio volatility is more important. You should have a little bit of value in your portfolio. If it underperforms, it's fine. How many people are going to take that kind of a mature call? Even those who said the strategy is important, I don't expect all of them to take such a mature call. So that's what I'm going to talk about. First, let's head over to the value research value-oriented fund page, and I'm going to show you the portfolio tab. I'm going to zoom in on this. I'm not sure if I can have to click here. So I'm going to zoom in on that. Excuse me. There you go. So have a look at that. So that's the style box. That's called the investment style box. And you can see that on the top you have the growth. You have the growth, the blend, and the value. And then that's the horizontal axis. And the vertical axis is large cap, mid cap, and small cap. Capitalization doesn't matter. Value oriented can invest across market cap, but a value fund should strictly speaking, that black dot should be found on the right extreme. It should be always found on the right extreme. At best, so that black coloring should be on the right extreme. At best, it can be a blend. Have a look at how the investment style of all the value funds in the portfolio is today. Growth, 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 growth. They're all value funds, remember, they're all growth. This is blend. What is that fund which has got a blend? ICICI Value Discovery. What another blend? What is that fund which has got a blend? Quantum Long-Term Equity. Blend, Templeton India Value Fund. Look at that, 2 star, 3 star, 2 star. So that's what happens. When you are sticking, the value fund is sticking to its mandate, at least it's having a blend, it's not even fully value, it's having a blend, star rating is down. That's the problem with all of us. The only exception. This is only exception is ABSL value fund. That's a value-oriented mid-cap fund, and that's not doing very well. That's a growth-oriented mid-cap fund, and that's not doing very well. There are only 3 funds which have got a blend style. Templeton India Value Fund, ICICI, and Quantum. All of them are suffering. All the others in the category have moved over to growth style and are maintaining their star rating and so on. So the question is now, answer the question, will you accept if the fund manager deviates from, they say they are a value oriented fund and they become a growth oriented kind of fund, just to make sure your returns don't suffer. Is that okay with you or not? It's up to you. If it is okay with you, well, anything goes. If it is not okay with you, so then don't complain about quantum long-term equity and ICICI value discovery. This is the sad state of affairs. We are comparing apples and oranges, giving them star ratings. We are comparing apples and oranges and assuming one is better than the other. This has always been the problem. Of course, on an absolute scale, quantum and value discovery have made mistakes. Where is the mistake they have made? They have chosen the wrong benchmarks. When you say you are going to be a value fund, you benchmark yourself against a value index. Don't benchmark yourself against PSE 500 like ICICI or Sensex like Quantum Long Term or BSE 200 Quantum Long Term as a secondary benchmark. Choose a value index and it's available today. So before we talk about that, I just want to head over to the Morningstar page of ICICI value discovery, and I want to show you. This is the style box, but it's got a centroid. It tells you typically where the maximum AUM is, or the major component of the AUM is centered around. You can notice that the value category basically has shifted towards growth. That's the red color centroid is the value category circle right here. And the BSE 500 itself is comfortably in growth. And the value discovery has a blend right in the center kind of style. So there's a big difference in the investing style of the benchmark and the fund, and the benchmark, and the category and the fund. So clearly there will be a difference in performance. I can argue, or anybody can argue, that value discovery has stayed true to itself, or at least it has tried to be partially true to its value strategy and has maintained a blend status, whereas the others in the category have moved away. And in the case of quantum, things are slightly better. At least quantum probably maybe because of its pressure to perform as the blend. It is still in blend, but it's kind of towards on the growth side. So maybe going forward, there may be the pressure. That's the problem with quantum, right? See, you can talk about mandate is important, style purity is important, focus is important, this and that, but you will get profits first. If you don't get profits first, what do? You have to break, you have to bend everything. So that's the problem, that's the pressure on quantum, and I don't know how long they can handle this. Let's see. But kudos to them for staying true to their style and still bearing the underperformance. Now we will talk about what is the right benchmark to choose. Now it's available. So now we'll head over to this presentation. Back again. And so I want to introduce you to the Nifty 500 Value 50 Total Returns Index. 50 value stocks from Nifty 500. These are based on low PE, low PB, low price to sales, high dividend yield, and so on. Notice how volatile the 3-year returns are. There are 2,593 3-year return data points in the white line, which is the Nifty 500 value 50 index, and the green line, which is the Nifty 500. Notice how volatile the Nifty 500 value 50 index is. Sometimes the performance is fantastic, sometimes the performance is terrible, and look at the performance in the last couple of years. It's pretty bad. It's dropped down. In fact, I would say right from mid 2016 onwards, except for a small spurt here, it has been going down. And if you actually look at the fund sheet for September 2018, sorry, this is September 2018. They've not, is it 19 or 2018? I don't know what that. I mean, I clicked on the latest fact sheet and I got that. I didn't realize the year was wrong. But it doesn't matter. Even if it is September 2018, it doesn't matter. Look at the beta of the Nifty 500 value 50 compared to Nifty 50. It is 85% more volatile than the Nifty 50. Over the last year, 58% more volatile over 5 years, and since inception, at least 25%, almost 25% more volatile. So it's significantly more volatile. In spite of that, quantum long-term equity, and so first let's compare quantum long-term equity, pink line, ICICI value discovery, blue line, with the Nifty 500 green line. Now, if you look at this, they have done well overall over every possible 3-year period. But since that early 2017, they've kind of dropped down below Nifty 500. That is the problem of choosing the wrong benchmark, in my opinion. And I mean, if you're a value fund, benchmark yourself against the value index. Otherwise, this is going to be a problem. Of course, what is value, what is growth? Those problems are always going to be there. Those definitions are always going to be murky. But that's like compare again for 3 years with respect to the value index, which is the white line. The white line is the Nifty 500 value index. It is done significantly better, but and notice that the value index has dropped way down, but these funds have outperformed. So I will now say, compared to a value index, which is algorithmically chosen, the active fund management in both value discovery and quantum long-term equity has been significantly better. They have reduced risk tremendously, and they have done this consistently. So it depends on what index you choose. And this is another side of the quantum long-term equity and value discovery story. They have stayed true to their investment mandate, at least in part, partially true, and they have paid the price for it. Whereas the other so-called value indices have nicely become growth and changed and made sure they got slightly better returns in the current environment. Are you okay with the fund manager changing investment strategy according to market conditions, even though it's not in the scheme document, even though it's not supposed to be done as per the category rules? Then go ahead and choose those funds. If you want a fund manager to stick to the mandates, choose these funds. But don't crib about performance, you have to wait. If you cannot wait, stay away from value altogether. Value is a troublesome category. Value and dividend yield. If you want pure value, then you have to go to the dividend yield category, and that's even more trickier category. I would suggest people with patience to avoid people without patience to avoid equity altogether. But people who don't have much patience, at least stay away from value oriented and dividend yield funds, because you have to go through these periods of underperformance. Including me, I am not saying I have tons of patience. How long will I wait? And the mistake is not just with the investors alone. The fund houses should change their benchmarks as well. So this is another side of the value discovery and quantum long-term equity story. So if you have any comments, share them below. I'll catch you later. Bye.